Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
The U.S. government threw money at the 2008 problem for exactly 1 year. They threw about $1 trillion extra at it, but then they went into stalemate mode. They put the sequestration plans in place, and we had very tight fiscal policy from 2010 to 2017. And you could argue that that tightness of fiscal policy perhaps made the economy recover from the Great Recession a little slower. But the Fed, of course, started the quantitative easing and just kept doing it for a while. So, you know, there's some different habits there.
Hello and welcome back. Our intro music switch up today is in honor of our guest today, Mr. Blu Putnam. We've had him on a couple of different versions of virtual webinars, turned podcasts and whatnot before, but this is our first one-on-one with the Chief Economist and Managing Partner at CME Group. So welcome, Blu.
Thank you.
Blu, you're known for explaining the happenings of the world simply with a couple of charts and some slides, giving a lowdown on the economic factors of the times that are helping or plaguing or confusing our world. And as we're well aware, between the coronavirus and everything else that's going on in the world today, current state of the U.S. and world economies are in a bit of flux. So there's plenty to talk about. And to start with, you were just out sailing somewhere?
Yes, I sail on the Chesapeake Bay. Beautiful place to sail.
Yeah, but you're here in Chicago.
I'm back in Chicago.
But usually you're in Chicago, right?
Yes.
So that's just a treat to go out to Chesapeake Bay and hit the water?
Just a treat. Yes.
What kind of boat?
It's a Islander 36.
All right.
It's a very old boat. It's like 40 years old or something, but it's a great sailboat.
All right. I used to do a bit of sailing myself. I've never sailed in the Chesapeake actually, though. So I'll have to put that on my list. And did you fly out there?
Yes.
What was that like?
Well, the plane was half empty and it felt safer than the grocery store.
Really? What was, which airline?
United.
United, all right. I feel like Delta's been getting the props for the best at it and American the worst. So maybe United's in the middle?
I guess so. It had the best route.
So tell us a little bit. We've done in some of our other pods some of your background, but can you give us a little cliff noted version of how you got to the position you're in at CME?
Yeah, I'm chief economist at the CME. I've been here almost 10 years and really enjoy it. It's a great company. Prior to that, I was involved in a consulting venture aimed at managing macroeconomic portfoliows for hedge funds. And before that, I actually ran some asset management businesses. And then before that, I was involved with sell-side strategy on bonds. And my first job was the New York Federal Reserve Bank as an economist working on international issues. So that's kind of the background in reverse.
Yeah, I like it. What year was that year at the Fed?
That's confidential information.
Before all their recent shenanigans, I bet that they couldn't have imagined.
Well before.
Yeah, in those days, that some of the tools they had in their toolbox. And what's going on at the CME these days? Seems like growing gangbusters as always, and more people interested in futures markets.
Yeah, there's definitely a lot of interest, particularly in the some of the newer products. The micro equity products are really doing exceedingly well. People are excited about gold and some other products. So yeah, things are going well.
What's it been like throughout your time with the CME? Do you feel like you still have to explain derivatives and futures, or has it become a more standard uh, tool in the toolbox? Not to use that twice in 2 minutes, but has it become a more standard tool for investors these days?
I think it's a more standard tool, or it's been a standard tool for me for a long time. I've always been interested in these markets, but you know, there's a wide group of investors that lots of different kind of investors use futures and options on futures. So I don't have to get in the educational business too much.
Right. What do you think's the most confuses people the most about futures markets, either from institutional standpoint or down to the retail?
Oh, I don't know. That's a hard question to answer as to what would be the issues. I mean, there are technical specifications for each product, and they are different. Some products, like the 10-year Treasury note, are a physically delivered product, and others are cash delivered. But you know, 99% of the traders don't hold a futures contract to a maturity anyway. So those differences don't really play a big role.
Right. I just got into the weeds on Twitter last week debating the roll cost or roll yield embedded in futures, and was kind of saying, well, people think it's the cost of having to roll to the new, more expensive contract, when in fact it's actually just the decay of the current contract down to spot prices if it's in contango. You got any thoughts on that? I guess it's technically correct, but we all seem to think like, no, you're rolling to the more expensive contract. That's what
No, I
causes
mean, that only happens in certain markets that have longer dated futures contracts, and you can trade further out the maturity curve. That would be true in natural gas, oil, corn, things like that.
yeah.
But in the equities, the E-mini S&P, you just go from the most active contract is the nearby, and then when that matures, you're in the next one.
And I have a side question for you. We were running some stats on running just holding E-minis to replicate the S&P performance. It seems to trail by about 2.5% on average. Why is that? That's kind of the cost of money there embedded in it.
That sounds like the dividend, but I'd have to do some research to tell you.
Yeah, in theory,
You're only with the E-minis, you're only dealing with the price index. If you own the ETF or something like that, you're getting the dividends.
got it. All right. Well, enough of my curiosities. Let's dig into the U.S. dollar. It's been kind of all over the headlines recently that is this finally the dollar sell-off? Has the Fed gone too far? Is inflation coming? All this yada, yada, yada. So let's talk about the dollar. What are you seeing in terms of the dollar index?
Well, there are a couple of things going on with the dollar, both in the U.S. and outside of the U.S. One of the main components in the dollar index is the euro. And the euro did some pretty exciting things in the last couple of weeks. One of the big problems with the euro that a lot of economists identify, at least, is that when the euro was created, they created a common currency and they created the European Central Bank, but there's no common fiscal policy.
Yeah.
And in the last couple of weeks, the European Union met. They agreed to issue bonds in euros for the credit risk of the whole European Union. And even more importantly, some of that money will go in grants to the countries hardest hit by the pandemic. So that was a huge first step toward a common fiscal policy or a united fiscal policy. And it really got a lot of traders excited about the future of the euro. On the other side of the Atlantic Ocean, in the U.S. Treasury has been issuing, well, they issued $3.3 trillion worth of debt in the first half of the year.
Is that a lot?
That's a lot. And the Federal Reserve bought half of that, not quite half, 46%. The Federal Reserve bought almost half. And so what economists call that is a fusion of fiscal and monetary policy. And the theory it goes under is modern monetary theory, or MMT.
Yeah.
And a lot of economists worry that you may be able to do that in a pandemic without any real consequences, and you probably should do it. So it's a good thing. But if you keep doing it after the economy recovers, then there's a big inflation risk down the road. 3, 4, 5 years, we don't know. So if you're worried about the inflation risk, you buy gold and you sell the dollar, and both of those things have been happening. So the dollar story's got a U.S. component and a euro component, and it's a complicated story, but really you can boil it down to those two factors.
Right, and the euro's 21% or something. I can't remember off the top of my head of what it is of the dollar index, but it's the largest.
It's a very good chunk.
Yeah, and what else is in there? Do you know off the top? Sorry to put you on the spot, but it's the yen.
Well, yeah, it's it's the regular cast of characters, the yen and the pound and things like that, Swiss franc, all make up part of that basket.
And so the euro side of that is people are betting the problems of not too long ago, even last year, right? The thinking was we're just getting Germany's economic input with all the other problems of the euro built into this currency. And now you're kind of saying, okay, they're trying to figure that piece out.
Yeah, that's right. You don't have to go back very far. And, Europe was stagnating. It wasn't growing very fast. Germany was leading, but then Angela Merkel kind of wasn't clear where she would be. And but now they've really, they've done something unusual. They've got a coordinated fiscal policy that they've never had before. And, there's a lot more optimism about Europe doing well in 2021.
And where does their negative yielding debt come into all this?
Well, they do have a lot of negative yielding debt. And I don't know who buys it, of course, because I wouldn't be buying a negative.
But if you wanted to
debt.
own, right, if you're on this trade and you want to own euros, you're going to put it in theory, you're going to put it in some.
It's going to be in cash, but the monetary policies.
That cash, right?
The monetary policies of countries are not all that different right now. The big countries, the big central banks are all doing quantitative easing. They're all buying assets, and they all have interest rates pretty close to zero. Maybe they're slightly negative in the case of the euro, and pretty close to zero in the U.S. But those differences are small. They're all in the same bag. What is different is the fiscal policies are shaping up a little differently. And that's showing up, and the expected growth rates are being a little different now, with Europe kind of maybe getting a little boost, and that's unusual, by the way. So that's helped them out. So those are where the differences aren't really in monetary policy.
So let's rewind back to the MMT here, and which side of the fence are you on there? That is going to cause problems, or I was just hearing about that new book, Deficits Don't Matter, or Stephanie's something. What was that book? You heard of it?
Yes, she is it's somewhere on the bookcase behind me.
Stephanie Kelton, yeah.
Yes, Stephanie Kelton. She's the chief proponent of modern monetary theory. It got involved as a very political issue because it was always attached to what you wanted to spend the money on.
Yeah.
So you would pick your issue, spend the money on that, and then the Fed would buy the debt that financed it. But in reality, it's a set of ideas that have been around a long time. Just brought together in a little bit of a different package. And when you're in an economic situation like the pandemic, where you're far from equilibrium, we've gone through what I call a network collapse. Doing something extraordinary makes a lot of sense. So the Fed actions and the fiscal policy actions are to be applauded here. What worries people is what happens 3, 4, 5 years down the road. The economy is growing again. And, there are some people out there that don't trust politicians to stop spending. And there's some other people that don't trust the central banks to stop buying the debt. And so it's the cynics, if you will, that are worried about the inflation down the road. But we'll see when we get there, we'll have plenty of time once the economy is growing again to see if policy can dial back or not. And, there's a pretty good chance the Fed will dial back. They understand these risks.
But so it's not the concept of how are we going to pay for it? How are we going to pay it back? It's more the concept of there's going to be too much money chasing too few assets and cause inflation.
Yeah, it's when the federal government spends money they don't have, what really matters for the economy is the actual new spending that's occurring.
Yeah.
Because what'll get the demand for goods and services above the supply and create the inflation. The fact that it's debt financed is an issue, but it's not the inflation issue so much. The debt financing of it makes the economy more fragile to any change in interest rates. So economies that have a lot of debt, an abundance of debt, more than typical economies, are much more likely to be reticent to raise interest rates, just because if you have a lot of debt and you raise interest rates, bad things can happen.
Yeah,
so that's a part of the danger.
Just popped in my head. Do you think U.S. will ever move to like the 100-year bonds or something to solve that problem?
They were talking about some very, very long-term bonds at the U.S. Treasury. I think at least 50 years or something. And they got a lot of pushback from the bond community, if you will, the investment banks and bond dealers. So at this point, I don't see it, but things can change.
Right. What's the 10-year right now? Like 50 pips or something?
Yeah, it's a little over a 0.5%. Yeah, 53, 56.
Right.
Pips.
So you feel like someone out there would be like, give me 1.5% for 50 years and I'll take it.
Well, 50 years is kind of a long time, and a long duration bond like that is going to have some interesting volatility, even if interest rates yields don't move very much at all.
Right. You'll have to survive to duration to see the effect of that. And I always come back to like Austria or someone issued 100-year bonds, like they weren't even a country for a 100-year period, like a country. So there's some other outside risks there of having your money tied up for that.
Well, in the 1800s, the United Kingdom used to issue what they call consols, and those are bonds that pay interest and they never mature.
Really? All right. What were the rates on those?
They were actually fairly low. I mean, you only issue these things when inflation is low and you're doing okay,
So I don't know if I heard your answer. So which side of MMT are you on? That it's okay in a terrible situation, but not all the time?
Oh yeah, you didn't really hear my answer because I dodged those kind of questions. I'm still doing a lot of research on MMT. I did write a research piece a couple of months back on it to try to really get my head into it and explain it. But I'm not on one side or the other. I think when you're far from equilibrium like we are now, it's an appropriate policy, and there'll be times later on where it's not appropriate, and we just have to see how carefully the politicians and the central bank deal with that when the time comes.
But what's different this time than 2008? Nothing? We just weren't calling it necessarily MMT in 2008?
Oh, no. This is a lot different than 2008. Mainly because of, well, two things. First, magnitude. In 2008, in the fourth quarter of 2008, the Fed did buy $1 trillion of securities, but it wasn't U.S. Treasury debt. It was to take the bad, toxic securities, if you will, out of the banking system. Yeah. And it allowed our banking system to recover much faster. What we had, a second difference with 2008 is while 2008 was a financial crisis, that the financial system didn't work for a short period of time, and we then went through a deleveraging period. The pandemic is not a price event. It's a shutdown, a government mandated shutdown because of a health crisis. So it shut down the restaurants, and it curtailed flying and all of those. The tourist industry suffered. And so anytime an economy is not responding to price signals, because it can't, then you cannot analyze that with Economics 101, okay? Because everything that we teach in economics at universities involves very important that agents and consumers and businesses respond to prices. And that's not what we're doing right now. We're responding to a health crisis and government orders and so forth. So it's totally different.
What would you say if it's right? A lot of the critique is it's not a liquidity issue, it's a demand issue, right? And you can't print money to solve a demand issue.
That's correct. And that came up back in the 1930s. The phrase pushing on a string was applied to central bank policy. because you had a severe demand drop in the depression, and we've had a severe demand drop from the pandemic, at least for certain types of goods, tourism, restaurants, air travel, things like that. And there's nothing the Federal Reserve is going to be able to do about that, or the federal government for that matter, except to try to solve the underlying problem. And the underlying problem we're going to call a vaccine. When we get a vaccine and we're able to distribute it, then consumer behavior can change again. So
Right.
that's not Federal Reserve policy.
But you can also, I could argue that all day, but I still printed this 3 trillion, gave out this 3 trillion. That's not going to solve a lot of those solvency issues for those groups that.
Well, the Fed buying the debt of the Treasury allowed the spending that the Treasury was doing, the U.S. government was doing to help into the pandemic. It allowed that to have less of an impact on bond yields than it otherwise would have. So, that probably helped the equities rally. I'm sure it did, because you have lower bond volatility, lower yields, so that's good for equities. So, it had an impact on the asset price markets. And it allowed the Treasury to get that money out there without impacting the asset prices as much as it might otherwise have. So I would argue it's appropriate policy.
What do you think the bond yields would have done if the Treasury hadn't bought those, or the Fed hadn't bought them?
Well, we won't know, but there are two ways of looking at this. And one way is to look at the history of the 10-year with compared to inflation, historical and recent history of inflation. And since inflation peaked in the United States back in 1980, 81, 82 at around 12, 13%, and there was a big gap. But over the time, as inflation came down in the 90s, the gap between inflation and bond yields narrowed. So bonds weren't offering as much of a premium. And more recently, in the last 10 years, bonds have really offered only a fairly small premium to inflation. And then when quantitative easing has become very aggressive, sometimes that premium went away. So if you're looking at that theory, you would argue that the Fed maybe has lowered the 10 years, maybe a half a point, 50 basis points lower than it otherwise would have been. But that doesn't tell the whole story. If the Fed is buying 46% of the Treasury's new issued bonds, then the bond market itself, the yield curve, is reflecting a complex combination of what private investors are doing, asset funds, hedge funds, whatever, and what the Fed is doing. And of course, the Fed isn't maximizing its profits. The Fed is trying to achieve an economic goal. So that means that the yield curve, the price discovery in the yield curve, doesn't mean the same thing it used to mean. And it probably is not telling you how easy monetary policy really is. So you have to look to other markets that are inflation sensitive to get some idea that maybe the yield curve is not giving the same signal it used to give. And gold and the dollar are telling you that there's some inflation fear out there. And so that would tell you that 50 basis points is an underestimate. But as to what the right number is, I don't have a clue.
So let's dig into back to the dollar a little bit. In our world of managed futures and trend following across all sorts of different sectors, or not even trend, but whatever your strategy is, right? The dollar, most everything is priced in US dollars. So a downtrend there can cause uptrends absent any other price movement in some of these commodities. What are you seeing in terms of that effect playing out in the grown in the ground commodities and other financial commodities?
Yeah, we are seeing some impact on the commodities. The metals are impacted, led by gold and then followed by silver the most. On the other extreme, the agricultural commodities are not really much affected by this at this point. They're being affected by the pandemic shutdown because restaurants are closed or not as open as they used to be, even though they're reopening. They're being affected by the oil market because corn has an ethanol component. So the ag markets are kind of not in play, if you will, but the metals definitely are.
But
And you go to energy, and like oil is 75% used in its refined state as a transportation fuel. And so you're looking at on the demand side, air traffic is simply not back, although people are driving. So the demand for gasoline to fill up your car is there, but the demand for jet fuel and so forth is not there like it used to be. And then on the supply side, we're seeing a huge drops in supply in the Permian Basin and other shale oil in the U.S., but we're probably going to see some increases in production in Saudi Arabia and Russia and parts of OPEC. So, oil has been trading in sitting around that low $40 range for WTI. It did get a boost from the tragic events in Lebanon, but that's temporary for that.
what do you see in terms of right? So when oil went to negative 37 or whatnot, and, I don't know, at the end of day basis when it went to $5 or something. And now all the way back to 40, as you said, is that more a result of basically them shutting in the supply of like, hey, we got to react quickly to this lack of demand, let's drastically reduce supply, or increase in demand?
Well, that was a very, very special one-day case just before the expiration or maturity of the nearby oil contract. And oil is a physically delivered contract. And so if you are an oil trader that studies that market carefully, you understand the issues of storage and where that oil is allowed to be stored to meet the contract specifications and so forth. If you're a retail investor or something, you have no business being close to the expiration of that contract anyway. So that was a very one-off. But markets worked very well. I mean, the markets traded all the way up and down. Every contract got filled. There was a buyer and a seller. The market worked. Just some people didn't like the outcome. That's a different story.
Right, but I would say ignoring that day, right, when oil went down, even if we say $10, right, it's rallied drastically off those lows in April.
Yes, on the day that the nearby went negative, the second contract in oil went as low as 10. So we've gone from 10 back to 40, and that's really a partial reopening of the economies, as well as the drop in production that's happening in the U.S. shale play, and at least in part of that, the OPEC plus Russia dropped production for a while. So there's some pretty good supply and demand stories there.
Plus some dollar weakness, right?
And plus a little dollar weakness because oil is priced in dollars.
And do you have any thoughts or concepts on how hedge fund strategies typically perform in a trending dollar versus non-trending dollar, or a weak or strong dollar?
Well, in the not so much in the last 10 years, but the foreign exchange traders used to wear, on their tie, "The trend is my friend." They no longer wear ties, and the trend hasn't been as friendly. But I think when you get a fairly large divergence in policy, and you get a perception that things are changing in one of the key countries like the euro, there's a pretty good chance that people will find that trend and do well with it.
And do you feel like that's partly globalization and coordination of monetary policy across all the G7 or whatever currency countries, that's kind of suppressed volatility and suppressed trends in the dollar and the resulting currencies?
Yeah, once we had the Great Recession in 2008, and Japan, your ECB, the Federal Reserve, Bank of England, they all went to near zero rates.
They all got on the conference call together, right? And said, all right, how are we going to fix this?
I'm not sure they had a conference call, but they all ended up doing the same thing. They do talk to each other a lot, but I wouldn't necessarily use the word coordinated.
Okay.
But they all ended up in the same place. And so it took monetary policy out of the equation for a long time. I mean, the European Central Bank, the Bank of Japan, they're still doing quantitative easing. Rates are still either zero or slightly negative. So, what you have moving the currencies is either changes in risk perception or changes in relative growth. And that's what we're kind of seeing that's changed with the Europe in the last month.
So I think I'd speak on behalf of all the traders that they would welcome lack of coordinated, even if we don't use that word, monetary policy would be welcome to all the traders out there.
Well,
Get
they should,
more
you know what,
volatility.
they've got it. They just don't have it in the majors. I mean, that's one of the interesting parts of the foreign exchange market is there are lots of opportunities for interest rate differentials and growth differentials and risk differentials in the emerging market currencies. Very interesting things going on, and that business is a growing business. So there's plenty of things to do. You just not necessarily in the majors.
And where are we putting the renminbi or the Chinese currency in there as a non-major?
It's a non-major until they loosen up their restrictions. Yes.
But do you see any that they'll become the reserve currency of the world? Do you see any threat of that or truth to that?
Well, you know, the dollar really has a pretty strong hold on being the primary reserve currency. But there are different issues with all of its competitors. So the biggest competitor to the dollar is portfolio diversification. So if you run a sovereign debt fund or you're running a central bank around the world and you're feeling that the US is riskier than it used to be, and the US maybe isn't coordinating with other countries as much as it used to, then you might say, okay, I'm going to change my currency mix. So I'll own a little less dollars, but I'm going to own more of a slice of everything else plus gold. So portfolio diversification right now is the challenger to the dollar, but not any specific currency.
Okay. So I'm not going to get you to wade into the Chinese politics there. Let's go back to gold. So is the gold story all about this dollar sell-off and inflation expectations, or is anything else going on there?
Well, the gold rallies had a couple of legs to it. And the first leg up was really the change in the Federal Reserve to not be raising rates. Okay, they were raising rates, you know, and then they stopped raising rates.
Yeah.
And then they started lowering rates. And then we got the pandemic and they really lowered rates to zero. So every time the Federal Reserve moved to an easier policy stance, you had another leg up in the gold market. And now it's not interest rates, but now it's back to our modern monetary theory, it's the Federal Reserve financing the fiscal policy and the fiscal policy become incredibly expansionary. And then the cynicism of the gold bugs is, wait a minute, once these guys learn how to spend, they may just keep spending.
Yeah.
I don't know if that'll happen, but that's the way a gold bug thinks.
When it feels like that from 08, like, oh, we threw trillions at it, it worked, let's do it again. Now, right, if 1 trillion worked, let's try 3 trillion.
Well, the Fed
threw 10 trillion.
That's true of the Fed, but not the U.S. government. The U.S. government threw money at the 2008 problem for exactly 1 year. They threw about $1 trillion extra at it, but then they went into stalemate mode. They put the sequestration plans in place, and we had very tight fiscal policy from 2010 to 2017. And you could argue that tightness of fiscal policy perhaps made the economy recover from the Great Recession a little slower. But the Fed, of course, started the quantitative easing and just kept doing it for a while. So, you know, there's some different habits there.
And what are your thoughts? I've been reading a lot recently on it's actually very tight right now for small business lending, like almost impossible for small businesses to get a loan, right? If they have revenue and they have profits, they're saying, well, we're uncertain of the future. And the flip side is they're lost their demand and they have no revenue or profits, so they're not going to get a loan. Are you seeing any of those stats?
No, that's correct. The issue here is the Federal Reserve can provide all the credit they want to banks, but the banks have to make profits. And in a highly uncertain environment where small businesses are struggling in many, many ways in many industries, those loans are going to be hard to get. And there's really, you know, the Federal Reserve wants banks to make good credit decisions.
Yeah.
And banks are regulated by the amount of capital they have and so forth. So the bankers are going to be very, very cautious in a highly uncertain environment like we're in about putting those loans out there. And that's where, you know, the fiscal policy, making some loans available to small businesses, the Main Street Lending Program, the Paycheck Protection Program, those were very welcome provisions, because the banks wouldn't have necessarily done that on their own, even if you gave them the money to do it. But in this case, the other thing on small business or any business, if you take on an extra loan, that helps you get to the other side of the problem, but it doesn't make you grow faster when the economy comes back, because you're more indebted. You've got to be more conservative with your cash and with your business plans. So, this is a complex issue, but, fiscal policy stepped in to try to help that, but, it's a huge problem.
Right. And are bonds and gold, besides the interest rate differential and the fear of inflation, they're also pricing in a little bit of like, maybe this is a depression era, deflationary environment based on all these small businesses not being able to grow and a kind of a permanent lack of demand moving forward.
Yeah, the jury's very much out on what's going to happen to inflation over the next couple of months. We've had some types of markets that have clearly been saturated with supply and their prices have gone down. But we've had other markets where, because of disruptions to the supply side, they were hard to get and prices went up. So it's not clear how much of a deflationary situation we're in, but we're definitely in a situation with much less aggregate global demand. Yeah. So you're not worried about inflation at all right now. And the possibility of a little bit of deflation is out there. It's definitely a possibility.
And what are your thoughts on we just keep having this further dichotomy between the biggest winner-take-all tech companies and the rest of the world, I think the 5 largest in the S&P are up 35% or something, and the other 495 are basically flat or down something. So do you see that as a problem long term? Not in their stock performance, but just if the largest companies just keep generating more and more monopoly, I'm be hesitant to use that word, but more power in terms of demand and customer interest, right? If we have the rest of the companies have no interest, where does that leave us?
Well, the pandemic has put us all working from home, or many of us, so it's made technology a premium. So technology is one of those industrial sectors which is a winner, if you will, or has opportunities to take advantage of with the pandemic situation. But competition tends to come out of the woodwork on these things too. So,
but even inside technology, right? It's the largest of the large are the winners versus the whole sector. I think that's
right.
A bigger issue.
Yeah, the largest of the large have gotten larger because were very well positioned to provide the services that we needed during the pandemic. And a lot of the mainline traditional businesses, building cars, building airplanes, things like that, are they're on the other side of that coin.
Unless you're building electric cars, and your name's Tesla, right? And while we're on these big tech titans, what's the logic in the Fed buying the bonds of Apple, for instance, who have 190 some billion in cash and don't need anyone?
Well, I think the Federal Reserve decided to throw the kitchen sink at issues. The problem. And they in particular did not want credit spreads to get too wide. They felt that keeping credit spreads on, so they instituted a variety of buying programs that they had never done before. They'd never bought corporate credit. They've never been involved in municipal bonds. They're not involved to a great deal of money compared to what they do in Treasury. Treasury is measured in trillions. These corporate credit municipal bond programs are 30, 40, 50 billion at most. Okay. However, the announcement effect was huge. All the Fed had to do is say, we're thinking about buying some of these things, and poof, the spread moved in.
Yeah. But I feel like Apple's spread wouldn't have moved down to begin with. So it's a little bit odd to do it in some of those names.
No, that's right. But on the flip side, the Federal Reserve is holding some not so good credits that have already been downgraded.
Okay, true. And what happens to that money? Does that accrue for the benefit of the U.S. taxpayer?
Well, we don't know. The Federal Reserve has never done this before. They've created some special purpose vehicles to buy these bonds.
Including
and now they're going to be on credit committees and things like that. And this is, excuse me, This is territory, this brand new territory for the Fed.
Yeah.
And I think they're going to probably they're going to have some challenges.
But that includes the purchases of the treasuries. So that 46% of the treasuries that they're buying, that goes into this slush fund as well.
I wouldn't use that word. Excuse me. The Fed has a really big portfolio. They're at $7 trillion. They were at $4 trillion on February 26th, so it didn't take them long to get to $7 trillion. Treasuries make up a huge component of that portfolio. Mortgages are next. And then these other things are pretty small. The Fed actually stopped increasing its assets on June 10th, or the week of June 10th. But they have been redeploying assets. So at the early stage of the pandemic, the Fed made a lot of loans, or we call them swap lines, to foreign central banks because the dollar was strong at that point. Now that the dollar is weaker, foreign central banks don't need that money. They've been sending it back to the Fed, and the Fed's been using it to buy intermediate and longer term bonds. In the initial part of the pandemic, the Fed was buying a lot of treasury bills and a lot of repo activity to make sure the overnight funding markets worked really well. That's the SOFR futures and things like that. Yeah. They work just fine. There are no issues there. So the Fed hasn't bought a T-bill in 6 or 8 weeks. Wow. They're more in the intermediate and longer end of the curve. So the Fed has, what it was doing in March and April, it's reassessed that, and it's adjusting its strategy as it goes along. So they're making, their portfolio decisions based on what they're seeing, which markets they think need help to function properly.
And can they just wipe some of those trillions off the balance sheet, so to speak, or does it actually have to be sold to someone else and become a real world asset?
You can't wipe it off. The Fed actually,
I bet they'll try. Someone will try.
They bought something, so they own a bond.
Yeah.
So it's going to be, we're going to see what they do to unwind this, if they ever decide to unwind it. It is a little bit habit forming, so it'll be interesting to see what the Federal Reserve's doing in 2024 when presumably the economy's in much better shape.
But in theory, if they sell those holdings back to another party, it's neither here nor there, right? That's not going to really cause an issue one way or the other.
No, I mean, after the Great Recession and when the Fed bought that $1 trillion of very different kinds of distressed securities, a couple of years later, they auctioned them off and made money on it.
And where did that money go? That back into the Treasury?
The Fed took the money in and bought mortgages and treasuries with it.
Okay, so it never is going to go back into the Treasury.
The Fed did shrink its balance sheet a little bit a couple of years back, but it didn't last too long.
Let me go back to, we mentioned gold and silver a little bit. What's the dynamic on why silver delayed there and then played catch up really quickly? Any thoughts on that?
Well, gold is the go-to currency when you're thinking about international troubles, when you're thinking about inflation risk. So gold was the first out of the block, if you will. But the gold to silver ratio got kind of out of whack.
Yeah.
And when gold was powering up, people were thinking, wait a minute, gold's gotten pretty far ahead of itself. So what we're seeing now is really a catch up to bring us the gold silver ratio more back into line.
Which is typically what, I don't know off the top of my head, like.
Neither do I.
100 to 1 or something, 80 to 1?
No, I don't know that ratio.
But essentially you're saying, hey, it should be rather standard through history of like.
Well, I mean, it's changed through history, but because silver used to have more industrial uses. Yeah. I mean, you might have been a photographer at one point and you developed film and you needed silver. We don't need that anymore. Yeah. Okay, so silver has adjusted to a different ratio because it's lost some industrial demand. But that happened that happened 15 years ago. So
Got
that's
it.
already done.
And then let's talk Bitcoin for a sec. So it's been rallying as if it were gold, as kind of an inflationary. Well, what are your thoughts? Is that rallying like as a gold proxy, or is it rallying as a speculative asset?
Well, it's rallying, I think, in part because interest rates are zero. People are looking around and saying, where can I get some yield? Where can I get some money? So it's what we call a search for yield. It takes you into riskier things, or more volatile things.
Yeah.
And Bitcoin is not particularly related to the fundamentals that might affect other markets. So, they're players in that market that do see value in adding that to their portfolio in these times.
And what are your overall thoughts on Bitcoin? Did you ever think you'd be alive to see the day of the virtual currency? Do you feel it's a currency or what?
I don't know what I would put category. I put it in the category of a futures product.
Yeah.
It's a futures product because the demand for trading it is out there. The exchange is agnostic. If people want to trade something, then if enough people want to trade it, then we might offer a platform for that, with what we did with Bitcoin.
I want you guys to do box office receipt futures. I feel like I'd be a great trader on that. Selling some of these new movies short, buying other ones. That'd be good. Cantor Fitzgerald tried that like 24 years ago, and I don't think it got approved. But
no, I mean there's a large number of really great ideas for futures products that haven't worked.
yeah,
I mean, we if you look over the history of the 100-year-plus history of futures exchanges, they're littered with projects that thought they were going to work and they just didn't. And that even when you do the research and you talk to people, they say, yeah, we'll trade that.
yeah.
But then they don't.
Yeah. Pork
we're getting,
bellies,
I have to say,
rest in
CME
peace,
Group, we're getting better at designing products. We've had, the micro equity products have been a big success.
Yeah.
Filling some of the gaps in the Treasury yield curve with the Ultra 10 and more recently the 3-year have been great ideas. So I think we're getting better at it.
And what is that Ultra bond one? What's the Ultra? 40, 50? What is that one?
That's essentially a 30.
Okay. And what happened?
You've got the Ultra bond, you've got the bond, which is closer to a average duration of 20 or 17 or something. Then you've got the Treasury note, which is like a 10-year, but you can deliver a 7 or 8 year into it. And then you've got the Ultra 10, which is a closer window of delivery. So it gives people, traders, risk managers, a really good look at the yield curve, and they can position exactly where they want to be on it, or run their risk management on the shape of the curve.
And then you mentioned the Fed putting overnight money for currencies. Have you seen the Turkish lira the last 2 days? What's going on there? It's like a 800% overnight funding rate or something?
Well, anytime a country has a lot of debt, particularly some debt not denominated in their own currency, and they have some political issues going on, and they're not growing, if they want to control, if they want to stop the weakness of the currency, rates could just go sky high for a little bit. So one of those places.
Just a way to protect their currency without going into the open market, so to speak?
Well, it makes the cost of shorting the currency very, very high.
Yeah.
And so that's the theory. And it can work for some period of time, but it hurts the economy. So there's a trade-off.
And how do they do that? They're basically just not loaning out any currency.
Yeah, well, it's kind of like the Fed setting the Fed funds rate, just pop that rate up there. So, I mean, and when you're dealing with emerging market currencies, the interest rate differentials play a huge role, and they're much more volatile differentials than they are with the major currencies, which aren't volatile at all right now. So you get some really nice moves in those interest rates, and then you'll get a big move in the currency. And so it's you've got to do your homework for those kind of trades.
Yeah, no thanks. And so let's circle back to the Fed funds rate that you just mentioned. How long, which I know you don't know the answer, but let's discuss, like, how long are we going to be at zero? Can we ever not be at zero? Right. Part of me is just in my real world of seeing friends in real estate and lending and whatnot. I feel like there's no way you can ever go back to 14% or something of like these mortgages that used to be in the 70s and 80s. I know we've talked before of never say never, but it seems to me that the world's addicted to low rates massively now. It'll be a big ask to go back.
Well, it's true that the major countries are very much addicted to debt, which makes you addicted to low rates.
Yeah.
But what can change, and we have no idea if it will or not, is the inflation environment. Inflation is very hard to start if you don't have any, and it's very hard to stop once you get a lot of it.
Right. See
And
Japan for the first one and see Argentina for the second one.
right.
Venezuela.
And the U.S. Had creeping inflation in the 60s. It started picking up in the 70s. And then when the U.S. tried to stop it, it took a long time. And it took 20% interest rates to stop 10% inflation.
Yeah.
Whereas, so really the inflation is going to be the key for whether rates stay very, very low. If we stay in a very subdued inflation environment, rates are going to stay low. But if inflation starts to pick up, then there'll be people that get worried about that. They'll have to protect themselves against the inflation risk, and you will start to see action on rates eventually.
And my problem with that is always I have huge inflation, right? Of Chicago property taxes, Chicago private school bills, and healthcare. Like those are all growing at 5 to 10% a year. So there's huge inflation there that doesn't kind of make its way into monetary policy or theory. How do you square that?
No, well, that doesn't square very easily. I mean, when we talk about inflation, we're talking about the average of the whole country.
Yeah.
We're talking individuals.
Not Jeff Malik's personal inflation.
Yeah, I mean, you got your head in the oven and your feet in the freezer and you're fine on average. That doesn't work.
Yeah.
So the averages definitely obscure a lot of interesting things that are going on, but that shows up with different sectors performing better. It shows up with the stock market maybe looking at one sector versus another. It shows up in people migrating to one state or leaving another. A lot of those things end up being coming into play, but not interest rates.
I just had that debate with someone the other day of whether it's ethical or moral to have, or wise to have inside the United States, basically different states competing for citizens by offering essentially tax breaks and no state income tax here, some income tax there. His argument would seem a more fair society if it was equal across the board in every state.
Well, we're definitely a collection of states that have quite a bit of discretion in their taxation policies and are quite different one from the other. And that's their choice under our system. So I don't think that's going to change.
And what do you have any thoughts or theories on whether, if all these people are moving to Austin, moving to Nashville from high tax states like Illinois, eventually it seems like they'll have to increase their taxes somewhere to pay for all that inflow, right? To pay for infrastructure and whatnot. So do they do it via, maybe they don't add a state income tax, but you're going to be paying for it somewhere.
Yeah, I mean, the states have to raise money somehow or another. And, like your example of Tennessee and Nashville is kind of an interesting one because they've really acquired literally some pretty amazing musical talent from different places around the world, including Detroit and places, like 10 or 15, 20 years ago, because Tennessee doesn't have an income tax. But it does have sales tax and it does have property taxes. And, it just depends on your own circumstances, whether it makes sense or not.
And what some people I know down there say now they have a traffic tax, not an actual tax, but the traffic is 10 times worse than it was a few years ago.
Yeah, I mean, I think you can definitely say that places like LA and Atlanta also have traffic taxes.
Yeah, and Chicago, except if you're like me and live in the city and work in the city, you don't experience it all that much. So we touched on that a little bit of basically you're just saying they'll come off zero when there's a threat of inflation.
Actually, they won't come off zero when there's a threat of inflation. They'll come off zero after the inflation has happened.
Which might be too late.
And they've actually, Chairman Powell has been very clear about that they're going to let inflation overshoot their targets before they get worried about it.
And so where will you see, what will be some of the signposts there to see when inflation has come back?
You just watch the inflation data. When people start talking about it in the newspaper, when your taxi driver starts complaining about it, when your Uber driver complains about it, when your long lost cousin is complaining about it, then it's back.
But in terms of real world, it'd be like, I can't afford to buy a house, and it'd be like San Francisco real estate right now. Like average household can't afford to buy a 2-bedroom home or something like that.
Yeah, cars. It'll when there's going to be we call it a narrative, but when the narrative takes over that the inflation is back is that'll be when the conversation starts at the Fed, and they will watch the data. But they were unable to get inflation as high as they wanted it. They couldn't get it to 2 or 3%. So if it ever gets to 2 or 3%, they're going to let it go to 4 and then they'll see what they want to do. But that's what they've told us.
And the flip side of that is they can never get it back, right? And then you're Japan, and what are the issues on that side of the equation?
Well, countries that are aging and that have an old demographic tend to have less inflation. So Japan is one of the older countries in the world. Average age is about 47. The U.S. will turn 40 in the next couple of years. But Western Europe, the U.S., Japan, and China, by the way, are all pretty older countries. And so, that dampens the growth in demand over time. And so you just don't sense this, that the inflation pressure is going to come back in that kind of situation.
But absent that, you'd see depressed stock market prices. What would the deflationary period look like for stocks, bonds, other asset prices?
If it's only 1 or 2% deflation, you're not going to see much reaction in stocks. But like in the Great Depression, prices declined about 10 to 15% on average. And that is a whole different game.
That's a whole new ball of wax. Yeah.
But we're not in that ball of wax. And that's why the Fed and the US government are spending so much money, is they don't want to be in that. I mean, 1932 was 3 years after the recession, almost depression had started. And both presidential candidates ran on a platform of balanced budgets. They were going to be fiscally disciplined. But it didn't take. Roosevelt won the election, and it was like only a few weeks later that he felt like this is not going to work. and he went after spending a lot more money and putting works programs in place, because once you're in power, you realize it's going to take something special when you're in that kind of depression situation. The pandemic shutdown, clearly called out the need for extraordinary fiscal policy.
Any other thoughts on that you have on what we got going on in the economy here?
Well, I'll leave you with the thing that I'm doing the most. I'm getting out of the prediction business, and I'm into what we call the nowcasting business. If you don't know where you are now, how are you going to figure out even where to go? And so as an economist, what we're doing is we're really, and I mean this in my peer group as well, we are studying a lot of data we never used to look at. Like I check every day now, I have it automated on my computer systems, but I check the number of people that go through security checkpoints at airports. I want to know if we're flying. And I can get that data for free every day.
Which we
Open Table, the restaurant group, they make their, Open Table makes restaurant seatings available. And I check that. Are we going back to eat or not? I'm actually looking at the data from New York City on how many people go through Times Square subway station every day. Because that'll be my leading indicator, among others, of when the work from home starts to ease off. I'm looking at transit, how much the commuter rail ridership is. And again, this is all public data that a typical economist wouldn't have looked at, 5 years ago, 2 years ago.
Yeah, it sounds more like the alternative data that hedge funds are using to get a jump on an economic number.
But I'm using all of this data just so I know where we are today.
Yeah.
Because that's what changes the narrative that generates market expectations. is if we get a change in this higher frequency data that tells us the economy's coming back, we'll get another leg in the stock market, things like that.
And
so we're using different data, and we're using it to just tell us, where are we now? Look out the window. Is it raining or what?
So tell us, where are we now? What do all those numbers look like? If 100% is all the way back, give us a rough percentage based on all those indicators.
Restaurants are about 45% back, give or take. Airlines are not there. They're in the more the 30% category, depending on the airline. Tourism is definitely even not as far back as that. So, those kind of the hardest hit sectors are not back to 50%, and some of them are not back to 30 some odd percent yet. On the other hand, the numbers on the pandemic cases, the surge that was going on in the Sun Belt states, that's starting to come down in places like Florida and Georgia and so forth. So we are getting some better numbers every day on some of the pandemic statistics.
And then we didn't even talk about employment. So all those restaurants and commuting ties in with the employment picture. What are your thoughts on the employment picture? Are those jobs gone forever, or they'll be tied to those statistics coming back?
Well, part of what drove me to alternative data was the confusion in the employment data.
Okay.
We started looking at the weekly new unemployment claims, and then we realized that a lot of states were 2 or 3 weeks behind in processing that stuff. So that's not so good. We don't know what's going on. We know there's still 1 million people applying for those claims every week according to the data, but they're lagged. And then we looked at the monthly employment data, and we discovered in the unemployment data that some people were misclassified, as the Bureau of Labor Statistics told us. And all of that data's lagged, at least a couple of weeks in the case of claims, but maybe more because of the processing slowdowns. And the jobs report is lagged a month, and it's only a snapshot from the middle of the month. So I think we're all going, in my peer group, we're all looking at any kind of data that's got a higher frequency on it that can tell us more. So the jobs data is not as important to me as it used to be, because by the time it comes out, I already know the story's changed.
Got it. And that would be the critique for your peer group and economists in general, right? Of you're dealing with a lag. Famously people say no better than a weatherman in terms of predictive power, but what are your thoughts on those critiques?
Well, weathermen have gotten a lot better in the last 30 or 40 years.
True. With some satellite power behind them, yeah.
Yes, with a lot of satellite power, and I do dabble in weather forecasting when I need to, particularly like, say, for spring flooding or not, and harvesting the corn and soybean crops.
Or when you're going out on Chesapeake Bay sailing.
Exactly. So I have a lot more respect for the weather forecasters than some people do, and so when I get compared to a weather forecaster, I take it as a compliment.
All right, done. And then one other thing you just brought up there, which I think is interesting, you're talking about the narrative, right? And you talked about that with inflation too. It seems the narrative matters more than the reality, right?
Yes. There's a lot of debate about how expectations get formed. And a lot of economists do very detailed quantitative studies based on historical data to try to figure out expectations. But many of us believe that the prevailing narrative is way more important. And it can get out of line with reality, but then reality catches up and the narrative changes and it bounces back. And so the proponent of this is Robert Shiller, a Nobel Prize winner, and he's written a great book on narrative economics. But yeah, I think understanding how the narrative is going to change helps you understand how expectations will change, and then that's how the market's going to follow those expectations.
And then it's not just there's competing narratives too, right? There's the actual narrative of all the investors and traders, but then you have the governments of the world trying to shape that narrative to make you believe what they want you to believe in terms of the data, right?
Yes, and when you get competing narratives, or sometimes we call them conflicting narratives, you can get some very interesting risk profile probability distributions, because if one narrative wins, you go one way. If another narrative wins, you go the other way. And so what that means is that the market today is pricing the average of the two narratives, and you're not going to stay there, you're going to go whichever one controls the narrative down the road. And so those are probably the most interesting risk events to watch.
Yeah, it feels like in your brain you think they might balance each other out, but it seems if it's 51-49 one way, that narrative takes control and the market moves entirely that direction. If it flips 49-51 the other way, it flies in the other direction.
Well, to some extent, that's right. But what I'm really worried about is when it resolves. Like, say it's 50-50 or 60-40.
Yeah.
And then you get some information that says, okay, the 60% narrative was right. The 40%, it goes to 100.
Yeah.
That's what happened with Brexit. I mean, that's the classic. Do I stay or do I go? And then, after the results come out, you're going to go. And so the pound drops 7% on the day. Anytime you get election risk or policy risk or OPEC decision risk, you can get people arguing one way or the other, and then you find out the answer and markets move instantly, quickly.
So now I was going to wrap up, but now we brought up election risk. So we got to talk about November. The VIX is.
I should not have brought that up. That was a mistake.
The VIX is pricing in a volatile period. Its curve is in backwardation and then pops in October there. So what are your thoughts? Is it going to be volatile? Is it going to be one of these binary events?
Yeah, I mean, I'm in the camp that thinks we're going to have some pretty volatile markets around the election and in a couple of weeks afterwards.
Yeah, and what do you believe the narrative is right now? That that'll be a Biden win or a Trump win?
The narrative isn't focused as much on the president anymore.
Okay.
It's shifted to the Senate.
Okay.
If you read the stories every day in the newspapers and different kinds of social media, there's a lot more discussion that the Senate might be in play. And that, we're pretty sure that the House of Representatives will remain Democratic, but we're totally unsure about the Senate. And I think that's the interesting debate, if you will, conflicting narrative, because if the Democrats have both houses of Congress, they will have a different kind of control. But if the Republicans have the Senate and the Democrats have the House, then you end up with a little more of a gridlock situation. So
got it.
That is, very interesting things to follow. But that, you typically get election speculation, if you will, or prognostication after Labor Day. People really get focused. So we're in the last month where we can tune this out, and then we're going to have to get serious.
Okay, I'm ready. Let's get serious. All right, let's finish it up with a few of your favorites we like to do. And thanks again for being here today. Favorite investing book, or I'll let you do economics book as well.
My favorite investing book is Graham and Dodd. It's from the 30s. I think you can reread that as many times as you want and learn something.
Okay. What's one good takeaway out of there?
You really have to do your homework. You have to think about risk very, very carefully before putting on anything, and you have to calibrate that. So it's a very risk-based approach to investing.
Favorite Chicago pizza spot?
I'm afraid that would be my wife's pizza.
Oh, she makes it homemade?
She can do it all, yes.
All right. Okay. You're going to have me over for one of those. Favorite sailing spot, Chesapeake Bay, or have you been others?
Oh, I've sailed a lot of places, and the Chesapeake Bay is my favorite. One of the things on the Chesapeake, there are a lot of restaurants when they're open that you can sail to and dock and have a nice meal. So it's destination sailing. The other thing is the Chesapeake Bay has a muddy bottom, sandy muddy bottom. So when you accidentally go aground, there's no damage. If you're on the Long Island, if you're on the North Shore of the Long Island and you go aground, that means you've hit a rock and you've got a big bill coming your way.
Yeah, I've hit rocks before. Off Florida, you hit the reef and it leaves a mark. And you're a tennis player too, right?
Yes.
Favorite tennis pro of all time?
Oh, wow. I would have to say Arthur Ashe. I'd go back a little bit, but he was just really amazing. But I also like Rafi and how he plays. I grew up playing on clay, so I do like that
So
surface.
Nadal, yeah, is the man there. He's only worth a couple $100 million these days. So.
Right.
And then rounded out favorite Star Wars character.
Definitely Pizza the Hut.
Pizza the Hut. All right, I'll take it. Thanks so much, Blu. This has been fun. Hopefully we'll get to see each other in person one of these days in the next couple months or years or whenever we're off lockdown.
All right, sounds good.
All right, thanks again.
Thank you.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.